Hello everyone, this is Andrew McNair from SWAN Capital with our Educational Economic Update for September 2016. In this month's video, we're going to be discussing some major headlines that influence markets in August and give you some insight into what it might mean for you as an investor. Now, as always, please stay tuned at the end for a required disclosure statement. So markets rallied for much of August on better than expected earnings reports and some economic data that also eked in. So however, official statements showed that the Federal Reserve is moving closer and closer to raising interest rates, which gave a lot of fear to investors. Now, with the bulk of corporate earnings season behind us, we have a pretty good picture now of how U.S. companies performed in the second quarter. See, if you look at the 483 S&P 500 members, we see that overall earnings are down 3.2% and that revenues are only up 0.1%. While lower profits aren't good, corporate managers did a great job of managing expectations. See, over 72% of those companies beat their earnings estimates, and just over half beat their expected revenues. See, the stock market treated this as fantastic news, as a huge win, since traders were completely surprised by these results. However, the Federal Reserve also was a big source of market activity last month. See, at the Open Market Committee meeting in July, economists are split on their opinions of the economy and interest rates. See, on one hand, we have the Fed hawks. They're ambitious. They want to raise interest rates. They think the market can withstand the higher rates, even as soon as September. Then we have the Fed doves, who are economists who favor a more cautious approach, who aren't convinced that a rate hike needs to happen so quickly. Now, the Fed is thinking maybe we should wait and see. Now, we and most Wall Street analysts don't believe that the Fed will raise interest rates in September. However, there's a reasonable chance that they may raise interest rates as soon as December. If the labor market continues to improve and economic growth looks solid, we could see higher interest rates as soon as December and before 2017. Now, speaking of economic growth, we got our second look at GDP, gross domestic product, and it showed us that the first estimate was 1.2%. Now it's down to 1.1%. So why the change? While consumer spending has ramped up last quarter, business spending has pulled back, leaving economic growth stuck in neutral. So what does that mean for you and I? It means consumer spending is the largest factor in U.S. economic growth. And it's going to continue pushing the economy and continue having the economy grow. But if businesses start to take a look at their profits, they're closing up their wallets and not spending. So what can an investor like you and I expect in coming weeks? It's likely to mean more and more volatility and perhaps even a pullback as investors are continuing to digest this data ahead of the November election. The Federal Reserve votes on interest rates this month, and that's going to fuel speculation. So as always, we're going to keep you informed. And that's it for this month's Educational Economic Update. If you're a SWAN Capital client, I highly encourage you to RSVP for our client event this month. September 24th is our night at the movies. We're going to have an 8-foot screen showing a really great movie that you can bring your grandchild or child to. So please RSVP by calling 850-380-9558. I look forward to seeing you at our next Educational Economic Update. See you then.